Happy Wednesday, and thank you very much for attending another session with RM Smart Investing. And I'm so pleased to have you. Today, we'll be talking about something which is probably the most anticipated subject in the markets, and it's all about the recession. Usually, recessions are either we missed it or they were a surprise, and here everybody is expecting recession. So what I thought would be a good idea, look at some understanding of what is recession, going back to economy 101. And the idea is, how do we know we are in a recession? And then based on that, what are some of the tools we could use as far as the timing of the investments, what vehicles we could use, what type of investments, looking at the history. So it is something that I thought might be a timely subject, especially now. And with that in mind, let's dive in and first of all, discuss what is a recession. Now, a recession is a significant, widespread, and prolonged, obviously, in some ways, downturn. Although it has become shorter and shorter, it's economic activity. So what it is, it is not a really concrete definition as far as the common rule goes, but generally it's said that if we have two consecutive quarters of negative gross domestic products, which we shall see, we had it in 2022, the first two quarters were basically negative, then they adjusted. That means that it was a recession, although there's actually more complex formulas are used. And this comes from the National Bureau of the Economic Research, the NBR, which they're the ones who look at the non-farm payrolls, they look at industrial production, the retail sales, and a few other factors. And then they come out and they, besides looking at the two quarters of negative GDP. Now, again, there is no fixed rule about this. And because of that, it becomes more difficult to find out when the recession started, when it ended. Usually it's on the hindsight. And the hindsight, they look back and say, oh, the recession started this time and ended. And there's always this discussion that when was that recession really ending? And so a lot of, when we look at for instance, the coronavirus recession, they came like almost 9 months, a year later. They said, well, it ended in June. So there is again no hard facts as far as understanding the recession. Now, since the Industrial Revolution, most economies have grown steadily, and again, we talk about even now the globalizations, and contraction are more of exceptions. So although it is still happening, so between 1960 and 2007, for instance, there were 122 recessions that affected about 21 advanced economies, about 10% of the time. So generally, when the recessions happen, they last about 7 months, and they used to be about 3.25 years in between. And that was really organic, because I think recessions are important. They are part of the business cycles. And it used to be a lot more normal, and it was more orderly. But now with the interference from the central banks, with the Fed, what happens, it has become really artificial. So for instance, what you see is like from 2009, all of a sudden you have this unbelievable 11 years of growth. Generally, it used to be, as I mentioned, about 3.25 years. So in recent years, it should have become less frequent and don't last as long. So the declines in economic output and employment that recession caused can become also self-perpetuating. And what I mean by that is, when the consumer demand goes down, that obviously companies, they have to lay off staff, and which affects the consumer spending power. So it goes around and around, and that weakens the consumer demand. So And similarly, in the bear markets that often accompanies recession can reverse the wealth effect, which is suddenly makes people less wealthy and further they have to trim their consumption. So what this is just a little graph about what happens during the recession. The unemployment rises. So you can look at some of the factors and say, well, if unemployment is rising, there's a less spending. And you actually look at the sentiment, people are becoming concerned. The consumer debt increases, the assets lose value, the interest rates drop, and then it's difficult to find a job. That defines the recessionary environment. The common causes, again, there was no one factor. It's difficult to find all the factors, but these are some of the common causes. Is it could be because of the high inflation, the environment that we are in. It could be high deflation. There's very much slowdown, sudden economic shock, the asset bubbles, for instance, bursting, now stock market crash, excessive debt, advances in technology, and then post-war slowdown. So all of these, they can contribute to causes of recession. Now, I've been, seeing many since 1970s, at least 5, and I've lived through it. So again, as I mentioned, the past recent memories have become more artificial than organic, unfortunately, the way the economy is. Now, let's move on and look at what if it's like really bad recession. So do we call that depression? And so what is a depression? Now, a depression is a severe and prolonged downturn in economic activity, and it is really extreme recession. Now, that lasts for years. It could be 3 or more years, which leads to a decline in real gross domestic product, or GDP, of at least 10% in a given year. Now, depressions are far less common. We don't see that, obviously. The one that everybody remembers basically is the Great Depression of 1930s, 1929, 1930s. And some people would think that the financial crisis that we had in 2008 also could fall into that. Of course, all the monetary and fiscal policy had to be aggressive to avoid that. So the U.S. experience has, as I mentioned, we've had 34 recessions since 1850, and we've had 5 since 1980, which I've witnessed. And in recent years, the Great Recession, and that's why it's called although some people call it depression, was 2008, 2009, and the COVID recession of 2020. But we only, again, we have to look at really a big depression that we've had. It was in 1929 till 1939, and that was called the Great Depression. So what are the 2 major factors characterizing a depression? Is the consumer confidence falls dramatically. People begin to worry about their job security. They don't want to spend, and investments obviously decreases as business individuals, they stop investing. And so there is no building new factories, so there's no need for employment or developing new product or even buying stocks. So some of the economic factors that characterize a depression include, again, substantial increase in unemployment, a drop in available credit from banks, diminishing output and productivity, consistent negative GDP growth, bankruptcies. Again, some of the recent memory, again, when you go back to the financial crisis that we had in 2008, some of these you actually probably witness yourself. The sovereign debt defaults, the reduced trade and global commerce, a bear market in stocks, falling currency values, and low to no inflation or even deflation, and increase in savings rate. The people who have the money, they don't want to invest it. They just want to be close to them. Now, economists disagree on the duration of a depression. Some argue that the depression encompasses only the period that is plagued by declining economic activity. Others argue that the depression continues up until the point that most economic activity has returned to normal. Now, on top of that, this term came in 1970s, and it was called the misery index. And misery index, it came after the oil embargo and the recession, getting off the gold standards in 1970. So what it does, it kind of marries the unemployment, the joblessness with the inflation. So we looked at those, they combine them, that becomes your misery index. It's, imagine you have no job, but you have to pay a lot more for your necessities. So since unemployment and inflation are both considered detrimental to one's economic well-being, then when we combine the value, it really affects the economic health. And again, this started in 1970s, and that's when really the development of the stagflation, which we'll talk about, which is again high inflation and unemployment. Now, that was used, actually, this term was used in 1976 campaign. At that time, candidate Jimmy Carter popularized it as Oakins, who's the person who started the term for misery index by criticizing President Ford. And because by the end of Ford's administration, the misery index was relatively high at 12.7%. During the 1980 presidential campaign, on the other hand, Ronald Reagan in turn pointed out that the misery index had increased under Carter. And this was his slogan. He said, recession is when your neighbor loses his job. Depression is when you lose yours, which is a term that Harry Truman started. Then he added this line, and recovery is when Jimmy Carter loses his. So he added to the spicy. And obviously, with the other factors, he was triumphed. So talked about stagflation, which is really worst of everything. It's very tough to combat stagflation. And what that is, again, it's a slow growth, unemployment, high unemployment, and combined with inflation. So we are right now in a healthy employment environment. Still unemployment is low, but obviously we have high inflation. Now, if unemployment starts moving up, which is, the Fed is willing to do up to a limit, they think about 5% will be good, sacrificing that to bring the inflation down. If it accelerates and all of a sudden employment keeps going down, keeps going up, then the inflation is not defeated. That's when we end up having that stagflation, and we will have something like misery index. So again, this is something that it was big time in 1970s, especially with the oil crisis in the United States, 1973, 1974. And some people actually, they still remember that. But the term stagflation actually was first used by British politician Lane MacLeod in a speech before the House of Commons in 1965. And that's when he combined the effect of inflation and stagnation as a stagflation situation. And then it was revived, as I mentioned, in 1970s because of the oil embargo, the oil crisis, and the inflation doubled in 1973. And it was double-digit in 1974, and unemployment reached 9% by May of 1975. This is something that it comes from the Real Investment Advice. Looking at, again, our emphasis on investments, and this is not the economic class, but talking that would be good to see the foundation. Looking at what happens beginning of the recession, when the recession started, when it ended, going through the years, and what was the effect on the markets. And you can see how much the S&P dropped from the peak to trough. So you see it in average, the markets, the mean has been about 29%. So basically, again, that's something you want to watch for. Again, as I mentioned, sometimes you don't really exactly know when was the start of it. So sometimes it's on the hindsight, but this is a little history. Maybe you can use it as a reference. The other thing is, this is from Bank of America, and they looked at what happens from when the bear markets from peak to trough, they declined, and what happens once we know the bottom is in, what happens from the trough the following 2 years. And you can see, for instance, in 1929, we declined 86% to 1932. That was a trough. But then from then, we were up 113%. It was unbelievable. I mean, 1930s are unbelievable years in many ways, very painful, but also a lot of money was made at that time too. So basically, just a little, again, reference. Now we're looking at January 2022. For now, till now, we are down 17%. So when we still don't know what the bottom is, we will look at that. One of the studies done to see what we can look at and when we can really know when is the bottom. Also, again, Bank of America has done another study looking at what happens if the Fed rate hike stops, so the last Fed rate hike. And, generally, the markets go up, but in inflationary period, Bank of America found out that actually in the 3 months and 6 months following, majority of the 3 months, the markets actually decline again when you have the inflationary period. So the markets drop an average of 4.5%, and 6 months 6.4%. The market do much better when there's in this inflationary period when the Fed has already stopped. So it goes to that madness of December 19, 2018, which I remember very well. And the markets actually had a really nice up for the next 3 months. And what happened was it was just the beginning of Chairman Powell's really inauguration that year. It was just the first speech he made, and the markets didn't like it. So then after that, he actually started, after raising the rates, I believe 3 times, then they actually dropped the rates, and in 2019, and that's why you have these nice returns. The thing is that we were not in 2018, we're in an inflationary environment. So just a food for thought. So so how do we know, are we in recession? How does the recession outlook looks, basically, and some of the tools we can use. So how do we predict a recession? There is, as I mentioned at the MBAR, there is no single surefire predictor. So one of the most accepted ones are inverted yield curves. They have come before each of the 10-year recession, 10 U.S. recessions since 1955. Now, there are not, so just because you have inverted yield curve, that has not translated to a recession. Every recession had inverted yield curve, but every inverted yield curve did not follow by recession. So when the yield curve is normal, short-term yields are lower than long-term yields, of course, because of the duration risk, because the longer term somebody is borrowing, the lender is taking more risk. But in the situation, for instance, a 10-year bond usually is more than 2-year bonds. But when there's a risk, for instance, there's a risk for the future inflation, higher interest rates, then the bond value goes down, and so all of a sudden that creates the upward yield curve. Now, the yield curve inverts if the yields on the shorter term are higher than the longer term, and that's where the weakness happens. So that's one of the criteria. You look at the yield curve and the spread between 2 and 10-year. The other one that I like better, and it's more important in my opinion, is the leading indicators. Now they look at the different parts. They are from the economic point of view. What are, for instance, the ISM purchasing managers, the conference board leading economic index, and the composite leading indicators. So they look at that. That has a better record. Now, talking about the 2-year spread, this just came out on March 24th from Charles Schwab, and it shows that this 1 month, I mean, it was an amazing month, the month of March. We had some of the most volatile times with the yields, the 10-year notes, a 10-year yield, and this was the highest since 1970s, as you can see. So it jumped by 50 basis points so far in March, again, only seen in recessions going back to late 1970s. So you can see these are the recessions, and every time we get up to here, a recession has occurred. So just a food for thought. But for me, is the leading economic index. And in February, it actually dropped 0.3% month over month, and year over year is down 6.5%. And it is more consistent with the recessions when we go back and can see the recessions. It coincides with the negative numbers, so every time. So that's one of the best ways to look at the 10 economic indicators year over year and see where we stand. So we are very close. We are in the negative side, and that also indicates that there could be a recession on the horizon. Also, when we have these yield curve at the invert, usually it breaks something. So this is on a hindsight. Again, we go back to what happened with Ben Bernanke, Janet Yellen, Jerome Powell. They created a big bubble in the banks, and now, of course, we know the story about Silicon Valley Bank. So every time we've had this negative, there's been something brewing. So we've had the subprime meltdown, the Lehman and AIG, and we had COVID, and now we have this SVB. So these are things that, again, some of the major events in history going back to 1960s. So again, more of a reference. And when we look at, again, we look at the inverted yield curve, we see that the traders are pricing in with growing conviction bets for the US recession. As I mentioned, this is the most anticipated recession. So the question is, we actually are in some segments of the economy are already in recession, and some segments are doing very well. So we might even have a sector's recession rather than the complete economic recession, especially when you look at the employment still, and also the spending habits are still there. So it is very difficult at this moment to really know exactly if it's going to happen. Of course, as I mentioned, if the Fed pushes harder, if we have a banking crisis really having legs, then obviously it will accelerate and start that movement of a recession. But at this time, again, there are positives and there's some negatives, although the leading economic indicator says there is definitely a possibility of recession. The other thing is when we look at the Fed hikes, and this has been the fastest we've seen since 1980s, which with Chairman Volcker, he was kind of apolitical in the sense that he didn't care. He did that. Nowadays, the politicians have thin skin. They will not allow, because they think such a short term, they're short-term sighted, that, for instance, Chairman Powell does not have the liberty that Chairman Volcker had. But look at what happens every time the rates have hiked. These are, again, some of the biggest events that have happened preceding the recession. So you see every time there's been a big, and then eventually everything goes down. So just again, more of a reference. So But not everyone is convinced that we are going to have recession, although it's so anticipated. This is the latest, just came out from Wells Fargo. So Wells Fargo thinks the global recession is actually off the table. It's saying that we no longer forecast global recession. The upward revision stems from a US economy that remains resilient, with the Eurozone, UK, and Chinese economies all appear healthier than initially expected. We now forecast that the global economy actually is going to grow at 2.2% this year, up from a prior forecast of under 2% last month. So that's what makes the markets, right? So a lot of people are expecting it. We got the, again, inverted yield curve. And here we are looking at all of a sudden that, the global GDP was 6% to 2021, while the average used to be 3.4%. So the forecast, again, they've upped their forecast. On the other hand, when we look at some of in March, the recession fears are heightening. For months, the Global Fund Manager Survey had shown investors assigning a lower likelihood of recession, but all that changed in March when the perceived likelihood has jumped to 42% from 24%. Again, this is from Bank of America Global Research, as you can see. And again, it precedes every time it has happened, there's been recession. But again, that's the survey, right? So the question comes to the next one. This is from Goldman Sachs. The consensus view is that we are going to have a technical recession by Q3, because the consensus is that by Q2 and Q3, we're going to be negative. The question is, when has the consensus ever been right? So again, we got two, in a sense, opposing views. But on the other hand, majority of, again, people are thinking that there will be a recession. As I mentioned, it is the most anticipated recession. Another thing we want to look at is we see that the S&P 500 consensus quarterly earnings, actual and consensus estimates for the next 3 quarters have been increasing, almost record base. So there is, again, when we think about the real GDP, the consensus is that it's gonna keep going down, especially third quarter and fourth quarter. There's a slowdown economically, but then they're thinking that the earnings actually in the second half will be increasing. Other thing about fund managers survey, they love cash and they hate stocks. Now, we looked at the last 2 weeks, this is as of last week, that the markets have gone up, and as we know, but you see the US equities, according to these managers for March, is the lowest, and it is most hated. Cash is loved. Emerging market equities actually been in favor. Alternative investments, healthcare, Eurozone, staples, energy, bonds, and then we have negative outlook toward banks and technology and UK equities. So just a food for thought. Again, there's when everybody thinks the same way, you gotta be a little watchful, but that's what the big money is right now. This is again from Bank of America. They're looking at this is what is interesting. Now, with this banking situation, as you know, the market started really pricing in that there will be a 0.25% increase in March. And now the thought is there actually going to be a pause in May 3rd, which is the next meeting. And there will be a cut in July 26th. So basically the peak of the fund rates will be at 5%. And then, so the market is actually looking at 2.8% rate by 2024. So, and you could see that with all what was happening with the banking situation, there was a flight to safety, and that's where the bonds were winners. And on top of, we've talked about how even NASDAQ, and we looked at cryptocurrencies, gold, alternative currencies, they were winners, but the lower rates obviously is helping the bond. So that's what anticipation is. But the question is, if the banking situation eases, then the Fed is going to go back to fundamental idea of, when you have over 6% inflation, is definitely far from the 2%. So that's something that they are really have to take into consideration. All right, so how do we invest? So with that idea, let's say expectation is a recession, whether it's today or a year from now or 10 years from now. Some of the ways that we can really analyze and see what is the best sectors, what are the best segments, investment asset classes. So this is just a little cheat sheet for the any type of economic announcements. Just want to share with you. So, for instance, when you hear unemployment is up, usually the stocks go down, the bonds go up, more of a defensive. Payroll employment, on the other hand, if it's good, the opposite, stocks love it, they go up, bonds or go down. Retail sales works for the stocks, the PPI, again, talking about the inflationary pressure, PPI and CPI have both negative effects on the stocks and bonds, and you live through it. So, but again, it's the expectations. So, and then the GDP, when it's healthy, goes up, the economy is good, the stocks do well, bonds go down. Housing starts is good for the stocks, not so much for the bonds. The purchasing managers index is positive for stocks. Personal income is positive for stocks. Index of the leading economic indicator, which we just discussed, is positive. So when it has been negative, it has been good for the bonds. Industrial production, good for stocks. Durable good orders, good for stocks. New home sales, it's a little different, whether there's going to be inflationary pressure or not, is uncertain for stocks. And car sales is good for stocks. So this is a little cheat sheet. So before we go as far as where to invest, let's just dive into about what is a business cycle. As I mentioned, unfortunately, it has been a little inorganic, and with the so much quantitative easing, so much monetary and fiscal pumping of money, things have been kind of artificial in my opinion, but generally this is what it works. So we talk about 6 stages of what happens to our economy. We have contraction, there's 3 waves or 3 stages, and then we have the expansion. So basically we have stage 1, stage 2 bottoming, stage 3 start the recovery, stage 4 it's happening. So let's just briefly talk about each stage. In stage 1, it shows the economy contracting and bonds are turning up as interest rates start declining, and economic weakness favors loose monetary policy. So we've witnessed that in the past, and what happened in the cutting the rates and lowering the rates, which is bullish for the bonds. The stage 2 marks a bottom in the economy. And again, we don't ever know. So this is really nice graph. The problem is knowing exact timing of it. So just letting you know, I mean, it's nice to have this theory, but anyway, so at least I mean, if you're close and basically to the economy, you know that if you are in the stage 2, not the deterioration of the economy has stopped, the economy is still not an expansion stage or actually growing, but stocks anticipate an expansion phase, and at that moment, then stocks and bonds actually do well. And this is the best time. Anytime there is a crisis, and I've been fortunate enough to be at the right time, and you go back to March of 2009, you go back to March of 2020, when there's so much fear, that's where the wealth has been made. Finding the best quality stocks. Don't have to have tons of them, just the ones that you feel that you always wanted. It's a good value. As a matter of fact, I give you one example, like Berkshire Hathaway, right? So Charles Munger, for instance, in his lifetime, he's seen it drop 50% on the stock prices 3 times. So that's but he's actually started, when that has happened, he's bought even more. So it's all about the quality companies, quality assets, and that's a good time. When we go to stage 3, it's now the economy is improving and conditions in this prepare to move to expansion phase. Now stocks are moving up, commodities are expecting that, and that's when now commodities, stocks, and bonds, they're all doing well. And we go back to 2009, 2000, actually, actually 2010, not 2009, but 2010. You can see that's happening. The stage 4, the period of full expansion. Here we are, and all of a sudden that it turns up. Both stocks and commodities do well. Stage 5, it's not peaking, and that time when it peaks, then stage 5, we have stocks and bonds both going down, and that's when the energy stocks and material, they do well. They give you a heads up. So commodities remain strong. And stage 6 is now, this is the stage that everything goes down and markets deteriorate. So I did a little went back and I looked at a little in the history, and I want to see when we had these big crashes and we had the recessions following. As you know, we had the dot-com crash from March 24. In March 24, we basically that's when we got hit. I want to look at what was the best performing sectors, and it will be interesting to see that for both of these, again, big crashes, the consumer staples actually were up, healthcare was down the least, and materials. So we will emphasize these two. And the reason is obviously healthcare is a diverse sector. So, and consumer staples is the same, but you still have to clean your brush your teeth, the toilet paper. You have to still eat food and drink beverages, and the healthcare, the drug stores. You still have to buy prescription. You still have to, again, take care of yourself. So the necessities, and the worst performing, of course, it was the internet and technology crash. It was that technology was down 81.9%, industrial 36%, and utilities 35.8%. Fast forward to the financial crisis, again, from the peak to trough, we had the best performing, again, consumer staples. They were down 28.5% from peak to trough, and healthcare was down 38%. Utilities were down 42.5%. Obviously, it was a financial crisis. So the financials were down 81.6%. Industrial, again, they were down 62.3%, and materials were down 57%. And then from the commodity point of view, going back again to 2008, you see there was only 2 commodities at that time that they were in positive. One was coal, it was up 12.6%, and gold was up about 5.8%. Everything else was down. Well, corn was down like 11%, and silver was down 23%. Natural gas was 24%. But look what happens in the recovery. When did 2009 happened? All of a sudden, what is the best? Now we are having the expansion starting, recovery has started, and now going to expansion. Copper was up 141% after being down 54%. And it makes sense, right? Dr. Copper, it's all about the health of the economy. And that's why they came back big time. And then you see lead, for instance. Lead was up 137. The previous year was like down 60%. And palladium and zinc. So all the materials needed, and they continue actually doing well. So just again, food for thought. This is a little simplification of everything. So when inflation start rising, the technology, industrial do well. When we overheat, now all of a sudden the growth is going below the trend. Now we see that in that moment the commodities doing well, and then when we get to the stagflation, the rates are going up to fight the inflation overheat. The cash is doing well. But then when we go to recessionary period, the bonds are well. And then once the growth is coming back and it's above the trend, that's where you get into stocks. And what we will talk about in the next few slides about consumer discretionary. So now there's positiveness, and that's why you want to have the cash to be able to take care of, buy some of the really undervalued growth stocks, believe it or not, at that time. So this time we're talking about value, but the growth stocks will do better. This one is a reference. This is not for me. It's something called economic clock, and it looks at all kinds of things from boom, slump, into recovery, and takes a look at some of the more factors that you could take, from the economic way, the higher wages, more competition, staff leaving. So it's more of a general look at the whole economy. So the next thing you also want to pay attention is something called the Baltic Dry Index, which is the shipping index, right? So it's calculated. This is not something. There's no volume. You cannot trade this. This is more of an indicator. So basically, it's real. By the way, it's not. It's not just hypothetical. They look at what is the average shipping rate charged for 3 different categories of dry bulk time charter ships. Now, when we talk about dry, we are looking at the lease rates for the cargo ships that they haul materials like iron ore, rather than hauling like containers or oil tankers. So the philosophy behind this is that this pricing tells us that what is the activity, what is the strength of economic strength. Is because the companies, more or less, they're willing to pay up for getting industrial essentials, materials shipped. So when the things are going up, it does better. When things are going down, it gives you the negative part of things. That means that slow down. So that's one way. But I want to share this, which comes from Tom McClellan, and that's the McClellan, the index, the summation index, which is, has been around for many, many years. So what he did, he came and used that as a leading indicator. What he shows that if you move forward by 26 trading days, the Baltic, it very much corresponds with the movement of S&P. So S&P follows the indicator of Baltic Dry Index, and you can see when it bottomed, the S&P kind of bottomed again here, and there's a little diversion here actually, but then you can see it started going down. Basically, it followed, and again the bottom, and so not 100%, but that was interesting. And we look at even going back to 2018 and the correlations you can see. So the bottom, and so just add a tool if you like to use it. I thought that would be interesting. So let's take a look at, I want to look at some of the yearly returns, and I want to emphasize what happened in 2000, 2001, but mainly 2008. The last big one. And of course, 2020 was so short-lived that basically with all the pumping of monetary and fiscal money, really markets are up. So you can see the big negative one, the last one we had was 2008. So S&P was down 38%. So I want to use that as a barometer. And you can remember, this is the first time since Great Depression in 2000, we had 3 years in a row down markets. So, and this slowdown in 2001. So look at the different asset classes, then you see the Russell was actually up in 2001 and only down 4%, but was big time down 2002. And it was down 35% in 2008. On the other hand, NASDAQ, remember, it was a technology collapse, really. They were down 37, 33, and 38%, but they were also down 42% in 2008. So if look at asset class, we talked about bonds. On the other hand, bonds were actually up 28% in 2008. Now, when the expansion started happening, the money started fleeing the bonds going to the, obviously you could see in this situation, the NASDAQ was up 54%. And when we look at S&P was up 23%. So the money went to those, and actually the markets dropped 25%, but after that, then they recovered. But also, as you can see, that 2022 has been a bond collapse, but things are changing now. So when you look at the way I look at this, this is going back to 2004. So I want you to pay attention to this 2008, and this is the relative strength. So what that means is we are looking at in 2008, how did the markets do in that recession with the market collapse relative to S&P? So bonds, you can see, they did very well, very strong against S&P. Of course, the following year and the 2 years, the bonds have been basically compared to that big bull market we had, especially in NASDAQ, mega cap growth companies. Obviously, they could not compete, but I'm emphasizing what asset classes have done that. Also, gold, you can see that gold was up 5%, and the following year, remember the commodity expansion, the recovery 24%, 30%, and after that, we had the drops and the dollar and the markets. So you see again gold. I'm looking at 2008, and you see again strength, relative strength is very visible, and then after that it's been just flat. The other thing in this segment we just talked about is the consumer staples. So as I mentioned, it's the necessity, right? So even when we look at consumer staples, as I said, it could be grocery stores, it could be any type of companies that mentioned toothpaste or toilet paper. Those are under the roof of the, I'm sorry, I'm talking about consumers. I'm talking about the healthcare, actually. The healthcare is a necessity, like the pharmaceuticals, but also the drugstores, for instance. And you see that they still dropped, but because they're very diverse, so there's a lot of companies there, and they were down 25%. But even in 2000, they were down only 11, 12, and then 1 and 1.48 compared to what S&P and NASDAQ did. So they are defensive. And again, necessity. Again, XLV, you could do something like Q or CURE, for instance. There's quite few healthcare more specific. So this is more general. And my goal is, again, I'm looking at 2008. You see, again, the relative strength is positive. So some of the the holdings in XLV is United Healthcare, Johnson & Johnson, AbbVie, Merck, so, and then CVS, for instance. So it's pretty diverse. So some of them respond, they're more economic sensitive. Remember, when it's a recession, you want to stay away from cyclicals. You don't want to be in companies that depend on the economy. You want to be on side of the necessities. It could be also discount retail stores, places like 99-cent store kind of a place that are Dollar General, that they actually attract people who used to go to Target, for instance. This is the one I was actually thinking of. The consumer staples is another defensive, and that's what I mentioned about the grocery stores, food related, as far as, again, necessities, toothpaste and other things. So you see they were down 17%. In 2000, they were actually up 24, and then they dropped 11 and 21. But they were down 17, which is a 50% better than what S&P did. So I go back again to 2008, and you can see again the relative strength. So they have done fairly well in this. The chart looks pretty nice above there. This is a 50 monthly charts and the moving average, so you can see they're doing well. So it's a very diverse again, holdings, you see Procter Gamble being 14%. Then you have Pepsi and Coca-Cola and Costco, Walmart, Philip Morris, I'll try the same thing, Target, Colgate, Palmolive, again, the General Mills, Dollar General, so Kimberly-Clark, Archer Daniel. So you can see, again, the holdings. So I want to choose the largest one was Procter Gamble. So when we look at Procter Gamble, there was a recession of like 1980 to 84. When you look at 81, 82, look what they did. And then when we come back to 2000, they were down big time, but then they had 2 positive years. And for 2008, they were down 15.8% compared to, again, the other indices. Again, I'm looking at 2008. You see the high relative strength, so big time. One of the other things is, although this is part of the discretionary, but you could also look at some of the auto parts, for instance. I mean, that's something that could be attractive. As I mentioned, there is people, because of the cyclicality, maybe they cannot afford to buy a new car. They rather fix their old car. So, O'Reilly or AutoZone. And again, I'm looking at the 2008, for instance, and we can see the relative strength and how they have behaved. So just another suggestion. Now, let's go to opposite. What does not do well? They are the discretionary. That's something at your discretion. Could be things like, for instance, Starbucks or Booking, or even Amazon, things that you want to spend money, Nike. So basically, some kind of things that they are not necessities, and or TJ Maxx, for instance, even though it's a little, going to, they still do okay, but they still, people might go even to lower end, and retailers don't do as well. So they were down. You can see that. They were down 2 years, and then they were down 34%. So when we look at, for instance, in 2008, you see there was very much flat. They followed what S&P did. So one tool I will introduce to you is to get the pulse of the market, to see when is a good time to go in, and if the market is really in a recessionary or expansionary or recovery, is the ratio of what we talked about, the staples to discretionary. So as you can see, from like 2022, actually even end of 2021, you see the strength of the staples. They have been up relative to when we think about discretionary. And we are actually right against the 200-month moving average. So that's when you can say that, using, like, I'm looking at the relative strength, right? So RSI, relative strength index, you can see here. So that's how you can move your, you can actually do the rotation, or even choose your stocks. Then maybe, well, does this recession, has it started, or this is anticipation? You can see there's been anticipation that, and it's more of a defensive, so the money has gone. So basically, in 2022, they did much better than the discretionary sector. So that's one way of staying in the right place. The other suggestions would be, you can actually invest in some high dividend paying S&P stocks, or there's ETF of like SDY. Granted, they were big time, they're still down in 2008, but it's better than what S&P did. That was down 38%. This is 26%. Even in 2022, look, they were down 3%. So this is another way of being defensive. Going back to Europe, let's say if you want to do diversification, things are a little different. I think we're in different cycles now, although the globalization is getting a little more limited. So, for instance, Europe is becoming more attractive with the dollar. Again, if there's interest rates are pausing, for instance, if there was a pause, and yet the euro interest rate, as central bank of European Central Bank decided to continue with their increasing rates, so it will be good for euro. So it makes it more attractive. But even if you want diversified, look at, I mean, the euro was down like even worse than us. It was down 45%. So you just have to be selective, although they were down 17% last year. We're looking at emerging market bonds. So you can see they actually were down only 7%. And they've done okay, but then the whole bond market and the dollar has been brutal to them. So there might be turnaround there. And even India, which has been a big winner since 2000 on, they've been on fire. They were down 52%. So just by going outside, you have to be selective. We think they have had big growth. Even last year, when all the markets around the globe were down, they were actually up 4%. And that's something you want to be careful. I think the paying a high price for the PE in India, so I will be a little selective not to go there. And Argentina, on the other hand, was a big winner last year, 142%. They were down almost 50%. So things that you want to avoid, be selective. And the last but not least is, I've shared this before, but it is something interesting that Bank of America has their checklist. It's called signposts, and they look at different 10 factors, and that's when they check and they say, well, is this a good, do we see the market lows? I don't have the latest one, but they have a good history. You can see every time there's been above 80%, we've hit the market lows. So as of like November 1st, they had hit only 2. Remember, we bought them in October from this cycle, about 3,500. We are over 4,000 now. But according to them, we were only at 20%. And at that time, 11/1, they were at 3,800. So just a food for thought, we can follow this. These are the 10 factors. So with that in mind, I'm gonna stop and open up for any questions that you have. Thank you so much.